Traders, welcome to this edition of Expert Market Analysis brought to you by Arante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. This will actually be the last webinar of this type, so whilst I just let you have a look at the disclaimer, I just want to run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories and narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way, and we'll be more than happy to answer those as we go, or at least at the end of the webinar. It's Wednesday, January 28th. It's just after 11 a.m. in London, so let's get to it then. Just checking out what we hope to get through in the next 30 minutes or so. We'll check out how markets are trading currently, then we'll look at these current themes. So many themes going on, but these have been the big ones very recently. Obviously earnings season, but also then the dollar collapse last night, and especially through this week as well. So we'll look at that along with the dollar yen and the yen move that we saw, which really exacerbated then this dollar sell-off that we saw very recently. We'll then get into some of the main data points from last week. Actually, this should be updated, my apologies. It should be what we'll be looking at is some of the central bank meetings from the Bank of Japan, and also UK data from last week, and then we'll get into a preview of the two main central bank meetings this week, which are of course the Fed and the Bank of Canada. If you just bear with me 1 second, I'll just leave you with a disclaimer, which is there for you just to have a quick look at. Okay. Apologies, I just wanted to edit one of the slides which hadn't been edited, so there we are. Now you can see that much better. So yeah, UK data first up to look at, then the Bank of Japan meeting, and then obviously these central bank meetings we get today. But markets generally this morning, just sort of pausing, if you like, after the US dollar sell-off late last night, exacerbated by Trump's comments, which we'll get to. And then of course we have those tech earnings, which we'll get into more detail shortly. The big story, of course, that calm in most major pairs, actually dollar pairs, since last summer got really completely shattered overnight, and late yesterday really. It started, if we just go back a step, with the Fed Powell subpoenas, if you like, over the weekend, then the Greenland crisis, of course, which fueled already lingering concerns about the stability really and relative worth of US assets, including the dollar. Then next came news about a potential coordinated intervention, that was last week, between the US and Japan, which we'll get into in more detail to prop up the ailing yen. But from the US side, it really signaled tolerance for a weaker dollar. That was hugely significant. And we saw a dramatic two-day sort of dollar yen slide, of course, up above 159, and now trading, where are we? Down at 152 in a matter of days. That slide really in a response really to with strong spillovers to all then other US dollar cross rates. There was some stabilization in early dealings yesterday, but it was nothing really but a false dawn. There was President Trump then late yesterday, which really was the big kicker. Asked if he was worried about the dollar's recent decline, Trump said it is fine and that the dollar is doing great. Instead, he pointed fingers at Japan and China, who devalue to be more competitive. And really, Trump's comments were taken as a go-ahead for further dollar weakness. That saw a big shank lower in the DXY, of course. Euro dollar, that soared from an intraday low around 118.50 to a high as I think 120.81 it got to before closing at 120.41. That was a new 4-year high. It prompted the first comments actually from ECB policymakers as well, because 120 kind of a line in the sand in some ways for the ECB. So expect more comments about that significant strength really. And I think one official warned that the central bank may act if further significant increases would lower inflation projections. Cable, that hit 138, first time in 4 years, I think. Most pairs driven by the dollar side of the equation. Greenback certainly at the center of attention today. If we just pause it there and pull up a chart first of all. The Dixie chart, so the dollar chart, hugely interesting really, and this move, sharp move lower. If I just get rid of some of these points here, you can see this shank really that happened on, well, Friday was the big kicker, obviously with dollar yen moving lower, so selling of the dollar, buying of the yen, that took us down below those December highs. And then we were focused on this dotted line, which is a long-term trend line, which I can show you from, 2021 and 2011. You can see that really, and it held the downside recently with that low in September of last year, and then that cycle low from June at 96.21. Those were the key levels along with that sort of long-term trend line, and it depends where you draw that, but around there. But we smashed through it again, and you can just see on the daily chart then, smashed through that long-term trend line, and we're just now below still that 96.21 level. Key resistance or support, and it'd be interesting whether we build on this break lower or not now, obviously with the Fed coming up in a few hours time. Amazing move really because of Trump's comments, and obviously then everything around de-dollarization. That theme is huge and long-term really, de-dollarization, and really dollar debasement as well. So that's essentially investors moving away from dollar assets because of course of policy uncertainty, Fed independence issues, and everything around those two factors really. So that was the Dixie. If I just show you then as well dollar yen, because we've seen that huge move in dollar yen as well. You can just see the Friday move there where we got to 159.22. That previous high though was back in, back in January of last year. That was at 158.87. So that was strong resistance. Tried a couple of times to beat it, but we haven't done so, and then we've fallen very, very sharply down to, as I say, 152.71 or so currently, through the 50-day moving average at 156.39, through the 200-day. I think that is the 200-day. Let me just double check on that one. Bear with me. That's the 100-day actually. So the 100 days at 153.64, and then a 200-day, I thought so. We're way below, but you never know. 149.75. Yeah, just on this yen, then another theme really, and could have significant impact on other markets as well. As I say, it fell off the cliff on Friday. Rumors swirling really that financial institutions have been asked to check on the yen's exchange rate. That typically is the last stage before actual FX interventions. This time around though, it wasn't just Japanese authorities doing the rate check, it was the New York Fed. That was the big kicker. That suggests basically possible coordinated FX market, an FX, a coordinated FX market response, in which basically one party, the US, essentially has unlimited firepower to buy yen and sell US dollars. Japanese authorities, of course, they've been frustrated over yen weakness for quite some time, and have since 2022 actually stepped in unilaterally a couple of times, the last time being in summer 2024, when the MOF, they sold around $100 billion worth of yen. Dollars, sorry, sold $100 billion worth. That was, well, the last coordinated buying operation actually was in 1998. So that's why it's very historic and really quite symbolic as well. Apologies for this, don't know why we're getting this. So yeah, we're now down to 152.70. Just a thought on why Washington would get involved. Probably two main reasons. The weak yen was adding really to last week's Japanese government bond sell-off and indirectly driving US Treasury yields higher. That if there's any financial instrument more important than the stock market to the White House right now, it is US Treasuries and those yields going higher. They want lower yields, they want lower interest rates because that really stops this rising cost of living, if you like, and would help going forward, of course, with an eye on those November midterm elections. The other reason a strong dollar yen was potentially unwinding the work of US tariffs on Japan and giving Japanese manufacturers with a very weak yen, of course, a competitive advantage. So yeah, really symbolic and really sort of historic move, really, if, of course, the New York Fed has combined with the Ministry of Finance in Tokyo to intervene in the dollar yen. So really, yeah, fascinating moves in FX finally, as I say, because it had been relatively calm, FX volatility relatively calm for quite a few months, completely shattered in the last few days for sure. The other big thing, of course, the other big move, headline grabbing move, of course, is in gold and silver. Just bear with me. I mean, the charts are just pretty much straight line charts. This is, of course, gold. I think we just broke 5,300, didn't we? Yeah, 53.11 now, the high. Again, fascinating moves. That breaking 5,000, of course, and then silver breaking $100 for the first time. Silver got up to $117, I think, on Monday, and we're trading just a little bit off that, I think, at the moment. Let me just double check. Silver, yeah, 111 bucks, actually down on the day now, rare sight, but we did touch $117 on Monday, as I say. Obviously, the dollar crash, if you like, or the dollar sell-off, moving lower, that really helps the attractiveness of gold and precious metals. And then, of course, we've had escalating geopolitical tensions, really boosting safe haven demand for gold and silver. Gold, I think, up around 20% this year already, after a 60% plus move last year. Silver up over 50% this year, I think, after a sort of 160% move last year. So continuing that robust performance from 2025. Move, as I say, driven by a series of geopolitical shocks, really. Washington's stance on Greenland, lingering concerns about US-Iran escalation, as I say, then the weaker dollar, lower real yields, and then this persistent policy uncertainty really reinforced investor appetite for hard assets. Silver is interesting because it reflects obviously safe haven flows, but also robust industrial demand. And we have to remember a much smaller market size than gold, and it has that dual role, if you like, as an industrial as well as an investment metal. And then along with tightening physical balances amid constrained mine supply growth, that really has put upward pressure and a sort of parabolic move in silver. Certainly conditions remain volatile, but the broader backdrop really does still remain supportive. Seems like everybody is very much long gold or silver, which is a small issue, but you know, the geopolitical tensions, central bank buying, structural supply deficits leave really both metals very well positioned. So yeah, just a touch on gold and silver, and of course this dollar yen rally as well. If we move on to stocks now, we do have about 100 of the S&P 500 companies reporting, and if we just pull up first up, well, the S&P 500, which is very close to 7,000 as we come into, of course, these results. As I say, 100 or so S&P 500 companies reporting this week, including names we've already seen like Lockheed Martin, decent results, Northrop Grumman as well, Boeing, decent results, RTX as well, all up yesterday, I think. We get Visa and MasterCard, I think, at the end of the week. And also GM were stunning results. And I think we haven't had Starbucks and IBM there on Thursday, I think. Everything grabbing the headlines and looking towards the Mag 7 stocks, though, and we get 4 out of the 7 Mag 7 stocks reporting this week, of course. Microsoft, Meta, Facebook's parent, of course, and Elon Musk, Tesla, they report today after the closing bell, and then we get Apple's results on Thursday after the US closing bell. Those 4 companies, more than $10 billion of market cap, which is over, I think, over 16% of the S&P 500, over 23% of the NASDAQ. So, yeah, huge ramifications for these results. Really, it's pockets of the market beyond AI that are performing most strongly right now. The Mag 7, I know, have been called the Lag 7 because they have been lagging. So really important, these results, really, and whether, well, we find out, yeah, for shareholders that have been accustomed, of course, to blockbuster results, whether now we want even more from them. The key will be, for many, of course, will be to what extent this massive infrastructure spending, funded increasingly by debt in some cases on the global arms race, whether that is paying off. And really, it's no longer enough to just beat forecasts. Companies have to smash them out of the park and then really offer really solid and racy enough guidance that makes investors, of course, feel comfortable about their strong valuations. If I just pause this, first of all, got a couple of charts to show you. First up, this one, which is again Mag 7 or Lag 7. I quite like this chart. You can just see the underperformance, really, that we have seen compared to the broader market and compared to foreign markets as well. That's been key, really, for a key theme for markets over the last few months now, with small caps outperforming big mega cap tech stocks, and then those tech stocks as well underperforming other foreign markets as well. So really key point for these tech titans for sure. Specifically on Microsoft and Apple, they're expected to post strong double-digit earnings and revenue growth, with certainly AI cloud for Microsoft, and then for Apple iPhone services as well, and China seen as key engines that can keep the wider bull market intact if guidance stays upbeat. If we look at a couple of charts then, first up, I've addressed Microsoft. Let's look at that one first, which is here. So you can just see we're now up to the blue line of 50-day moving average. That's at 479.63. We just closed above that actually yesterday. We've got the black line, the 200-day moving average at 485. Interesting, the 50 days dropped below the 200-day. Generally, that is seen as a bearish sign, so we'll watch out for that. We've got that swing low from earlier in January. That's a 438.68, so a key level there. Otherwise, then upside, if we do break above the 200-day, we've got a little bit of resistance around here below 500, and then sort of next port of call, sort of 511 or so. I think the option markets see a move plus or minus, or up or down, of 4.6% in Microsoft the day after results on the open Thursday, that would be. For Apple, again, for Apple, they report, as I said, after the close tomorrow, but just with the chart here, yes, let's have a look. We've got a long-term high from 2024 at where 260.10. We're just trading below that, so that's an interesting point of reference. Potential resistance, 50-day moving average at 269.07, and then below here you've got this swing low again from mid-Jan around 254, and then the 200-day moving average at 235. That is Apple. Options markets see plus or minus move of 3.7%. That would be on the Friday open. For Meta, that's forecast to deliver hefty ad-driven revenue growth, but really close scrutiny will be on AI and Reality Labs spending. If we just check that chart then, just hitting the 200-day moving average, interesting level there, 678.90. Otherwise, the 50-day down below, which is the halfway point of the Liberation Day rally up to the record highs, that midpoint at 638. And you've got the 50-day moving average at 641.85. If we do beat the 200-day, then yeah, 721 probably minor fib level, a target for the bulls. Meta options market see a plus or minus move of 5.8%. That would be on a Thursday's opening. Finally, Tesla then as well. Obviously, interest around Elon Musk, what he says. Potentially really about robotics away from EVs and their selling numbers. It's expected the company to show weaker EPS and revenue on price cuts and margin pressure. Yeah, focus will then be on guidance and sort of concrete guidance rather than sort of unrealistic numbers around sort of robotics, battery storage, that kind of thing. Yeah, 50-day moving average in Tesla at 442. We've got a minor fib level at 431. 200-day way below at 374. But you've got these swing lows around 389 if we do lose this initial support earlier on in January at 417. Okay, that is all the stock stuff. Let's now go back to the graphics. And just check out first up some of the UK data and then the Bank of Japan meeting. Here's just inflation rates really on UK. We did get that data out last week. No surprises really. Modest pickup in inflation seen into year end. December, that picked up from 3.2 to 3.4. Just 0.1% higher than expected. The core rate, that was unchanged at 3.2, and services, key number for the Bank of England, that was at 4.5% from 4.4, so actually 0.1% weaker than expected. Transport, the key area there, related to airfares over Christmas really. And core services, also a number that the Bank of England look at, that was unchanged at 4%. We also got jobs data actually last week. That's underlined really the worsening of the UK labour market. The employment data that revealed a 43,000 drop in employment in December, following a 33,000 drop in November. That was the largest decline since COVID, and really will further raise, or has done, expectations of a continued decline in wage growth. That wage growth was less compelling, but still indicated a gradual softening. So private sector wages, they slowed from 3.9% to 3.6%. Actually, that was the weakest growth rate since November 2020. So inflation and wage growth figures combined, probably not going to alter the views of the Bank of England too much, and kind of have not too much impact on shaping policy rate expectations going forward. There was a lack of market reaction to that really, and possibly the Bank of England slightly underpriced for rate cuts ahead. Only about 6 basis points of easing by March really, and that sort of easing has been pushed further out as well, not till sort of June, July or so, the first rate cut I think fully priced in. Certainly Bank of England will be looking for more disinflation, really, as potentially the labour market weakens. That is for a few months' time, though, and probably not just yet. So really, they will be sitting on their hands, you would think, at the February MPC meeting. If we pull up cable, bear with me 1 second. Obviously, cable being massively influenced by the dollar sell-off. So we'll look at euro sterling as well. You can just see hitting multi-year highs, cable there, going back to where we were 2021, late 2021 or so. Those levels. We're just now at that previous high from June of last year at 137.84. So we're just below that. Interesting whether that is a level of resistance, which it should be, or support potentially. And we are overbought, of course, on the daily RSI. I should say I was going to show euro sterling, which is slightly more representative of issues around sterling generally, rather than obviously looking at the major, which has the dollar in it, and that has collapsed. So you've got the 200-day moving average supporting euro sterling, that's at 86.64, the black line, but you've got resistance at the 50-day moving average, that's at 82.27. Pretty clear cut there as we're trading in that range. Upside breakout then looks at 88.65, that high from November. Otherwise, downside breakout depends if we can hold on to this level here, which is from August last year, around 86 or so, just above there. I'm just checking here then what's next up. If you just bear with me 1 second. We also had, of course, the apologies, just checking something, the Bank of Japan meeting. Let's just get to that now. I'll just show you, I've showed you dollar yen actually, so not much to show you there. I can show you, what I'll show you actually is some dollar yen crosses, which are of interest, of course, because we had a huge move to the upside, sterling yen, euro yen hitting multi-year highs. Let me just show you. And then we've, or very close to those multi-year highs. If I go back here, you can just see how we broke. I've got dotted lines everywhere really, which are huge high points where we then collapsed. You can see that at where were we? This is euro yen, 174.74. Then we went to 178.45 and didn't quite get up to 188.22. But I put those in there, and we hit one of those, you can see, in June of 2024, and then collapsed. But then this move higher, really, really strong in euro yen as yen was weakening. And then we didn't quite touch that 188.22, as I said. But now we're touching the 50-day moving average. Interesting whether we can hold that. That's a 182.74. But you've got those long-term levels still to look at there. Touched on the Bank of Japan meeting, really. That was relatively hawkish, although that was a slightly odd reaction because dollar yen went higher and posted that high in the end. The Bank of Japan, they kept rates at 0.75%. As I say, slightly hawkish, 8-1 vote, one member calling for an immediate hike to 1%, arguing inflation already at target and risks were skewed higher. The bank basically upgraded near-term growth forecasts, helped by government stimulus. They did leave the headline inflation mostly unchanged, but the key was a shift in underlying inflation. So core CPI now forecast higher across the entire outlook, driven by tightening labour market and rising wage pressures. The bank openly acknowledged that labour shortages mean wages and prices could rise faster than expected. And if that outlook then plays out, it will then continue raising rates and dial back monetary support. Markets really on board with that. They see a hike to 1%, fully priced in by June, and actually year-end rates sort of above that, towards 1.25% to 1.5%. The FX reaction was muted initially, but then of course we had all that excitement over intervention. Further fiscal stimulus does look inevitable, with of course the election going to take place on February 8th, and most parties really looking at more fiscal stimulus. As I say, that would potentially kick off with VAT cuts that is promised from all the major parties. Just bear with me 1 second, slight technical issue here. Apologies, just showing you the dollar chart again. But just talking about the Bank of Japan then, yes, hawkish in its entirety, although the reaction was slightly muted. And of course, we've then seen these moves recently in, of course, dollar yen and all the yen crosses, with yen strengthening on this intervention. But yes, the meeting to think about and going forward, really signaling rate hikes as well, which again puts pressure on dollar yen to move lower going forward. Okay, let's move on then to this week's main events, which are, of course, the Fed meeting and the Bank of Canada meeting later today. First up is the Fed meeting. Widely expected to leave the policy rate unchanged at 3.5% to 3.75%. That's at today's meeting, of course, as has been the case for several meetings now. Decision itself matters less than guidance, really, particularly around how patient policymakers intend to be before possible easing comes into view. Recent data, well, that's continued to underline the resilient US economy, really. Growth being solid, sticky inflation, record highs in stock markets, of course, really argues against any urgency to cut rates. We've got in here a couple of those key numbers, still way above the 2% target, of course, inflation, and well, the labour market stalling and slowing, but certainly not collapsing. Otherwise, economy has expanded or did expand very strongly in the second half of last year. And this all then reinforces this idea of a pause, policy pause, and really preference for patience and a wait and see stance by the Fed. They will be data dependent, certainly. Avoid probably any signaling that easing is imminent. And then markets, of course, will pay close attention to Chair Powell's press conference, any tonal shift. But really, probably most headlines will be all about either or both the dollar move, Trump's comments, of course, and then growing political pressure generally on the central bank. Public criticism from President Trump, of course, ongoing legal scrutiny around the Fed's renovation. They will raise questions around institutional independence, but certainly we think Trump will steer clear of any political commentary. It would be very, very surprising if he did. Of course, not excusing that he did do that video over the weekend, a few weekends ago, really pinpointing his subpoenas on the fact that the central bank wasn't cutting rates and there was pressure to do so. We shall see in the press conference, but really he will probably likely steer clear of any political comments. Overall, the balance of risk for the Fed then, they point to rates remaining on hold through Q1. Rate cuts possible later in the year, and I've got it in here. It's around still 47 basis points of cuts still priced in by the markets. That's 225 basis point cuts essentially, even though let's remember the Fed's central production made in December was for just one rate cut this year. So interesting difference there, and the market's still holding that idea of 2 cuts. Whether there is any pushback on Powell and a pause, he explicitly says, then that will get reined in and could potentially support the dollar going forward. Of course, we do get those earnings, and if they're soft at all, then that could put pressure on the dollar conversely. That's the Fed. Then we've looked at the XY chart. I've just got a few other charts to reinforce. The labor market around 50,000, that was the last print, expected 55. So yeah, slowing but not collapsing, as I say. Then we've got different CPI rates there. The core and the headline still somewhat above that 2% Fed target. And then we've got the central projections in here from December, still relevant because you can just see one rate, 25 basis point rate cut expected. And then you've got some of the inflation and growth forecasts as well. So that's the Fed. We also potentially have the Fed chair nominee announcement. We're still waiting for that. And last time we spoke, I think both Kevins were very strong favorites, with Hassett going above Walsh, sorry I forgot his name, and then flipping, that was. But now we've had a bit of a change there, which is interesting. Rick Ryder, BlackRock's Rick Ryder, that is, no experience of the Fed, which could be a good thing or a bad thing. He is now in betting markets at least the favorite now, around 47% chance of him becoming the next Fed chair. Interesting choice, of course. And whether we still get them rate cuts, of course, which is what President Trump wants, will be the key thing for markets. When we did get Walsh being the favorite, actually, we had Treasury yields go higher and a little bit of support for the dollar because he is not seen as dovish as Hassett. But then Trump backed down from Hassett taking the Fed chair mantle because he commented that he would like to keep him in his present position. We shall see. Okay, finally, let's look at the Bank of Canada, and we'll look at dollar CAD, sorry. Just bear with me 1 second. Which is here. You can just see this collapse in dollar CAD, of course, as the dollar's gone lower. For the Bank of Canada, yeah, again, similar to the Fed, they're going to sit on their hands, keep rates as they are, rates there at 2.25%. Data-wise, headline inflation did rise actually from 2.2 to 2.4%, slightly above expectations, but really reflecting unfavorable base effects. That means really the bank will look through those numbers because core measures and the preferred core measure as well, that actually eased and really just shows the underlying price pressure trend remains relatively contained. They won't be swayed by just month-on-month volatility in that headline number, and instead, of course, focus on the underlying trend, which is, as I say, in the sort of mid 2% range. There are, of course, ongoing upside risks from US tariffs and certainly elevated trade policy uncertainty. We had that very recently with Trump ratcheting up those tariffs because of the potential China-Canada trade deal. Watch that space really, because that's ongoing. But really then it probably means there are market expectations that the Bank of Canada keeps rates on hold at 2.25%, possibly through the whole of this year. We shall see. For dollar CAD, you can just see that where we got up above the black line, the 200-day moving average, that's at 138.31 now. But we got found resistance at the blue line, the 50-day moving average, that's now at 138.43. Collapse then, taking out that low from December at 136.42. So really now we need to move this down to roughly, just roughly, that low from June of last year, which is at 135.38. That is strong support, and it'd be interesting whether we can hold that or not. If we do lose that, then where do we go? Down to potentially this low. Well, the June low, as I said, is at 135.89, but I have got a lower low than that at 135.40, I think. No, sorry, 135.89. I just haven't quite accurately done it there. You've got the 200-week moving average. That's interesting at 136.10 as well, and we're just trading around that. Okay, we're going to wrap it up there. Thank you so much for being on this webinar. Really do appreciate it. Really do appreciate all your support through the few years that we've been doing this. Take care out there. Lots going on. Very exciting moves. Lots of opportunities. Do take care out there though, because of the headline havoc and also just generally sharp, very sharp price action. Good luck and yeah, all the best.